Good morning, everybody. This is Ryan, and we had a little bit of difficulty getting into class here, but we're rocking and rolling now. So can I get a comment from somebody that says you can hear me? Aha, there we go. That's what we're like. All right, well, let's jump right into this, and I won't waste any time. And give me a confirmation when you see the slides come up. And we've just got a few slides today. We're going to be doing a lot of chatting about some specific things. It's going to be a fun class. But as we always do, we want to start out with the acknowledgement. Screen sharing. Okay, can you guys see the... Let's see. There we go. Perfect. Thank you. All right, guys. Well, we always have our little disclaimer out here. You've seen it 100 times. Bottom line is we are not going to be talking about any specific trading situations that you might be confused and think, oh, I should jump out and buy this right now. That's not the case. It's not intended to be the case. However, we are specifically talking about market situations, and just recognize that this is education and training only, and be smart about it. Okay. All right. Calendar's coming up, guys. Rob's got a full plate on here for you. There's so many things going on. I hope you keep track on your portal for all the things that are coming up. And here we go. So guys, this is one of my favorite subjects to talk about, because it's a concept. And my specific training, and I'll go over this when we get towards the end, but the specific training that I'm bringing to the table has to do with certain type of tools, ultimately trading. But there's a principle involved that I think is absolutely critical. So it's a little bit high level today. I'm not going to go into a super lot of detail, but it is absolutely mandatory that you understand this. Otherwise, when I say mandatory, it will solve a lot of problems for you. It will save a lot of headache and frustration if you can allow it to be what it is. I love the little phrase that says, never try to teach a pig to sing. It wastes your time and it annoys the pig. Okay? There's nothing wrong with trying to teach a pig to sing. It's just, it's not going to be really very fun for anybody, you or the pig. Right? It is what it is. And so if you let the pig be the pig and you can sing the song, then everybody's happy. All right. So price movement. Why is it a mystery? Because, because everybody's always wondering, what the heck, why did that happen? What's going on? Boy, I didn't expect that, et cetera. Or I really thought it was going to do this and it did that. All right. So price movement, guys, price movement, whenever stocks move, there's always an explanation. It's just often the reason is not given. And sometimes the reason that's stated isn't true. Sometimes that's done deliberately. I kid you not. And well, it shouldn't be a surprise to anybody, but sometimes there's very deliberate efforts to mislead people with regard to what the news was or what happened. Often the reason doesn't match the movement. Hey, the news came out, it was bullish and the stock went down. Well, there's an explanation. What is it? I don't know. It wasn't explained. Well, they said this, that doesn't make sense. Well, it's probably not true, right? But there is something going on and there's an explanation for it. Now, is it crucial that you always understand or you get that explanation? The answer is no. No. I mean, guys, you could spend your entire life trying to figure out all the details on stuff. I love the analogy that says, if you want to learn how to start a car, stick the key in and turn the ignition and then put your foot on the gas. You used to have to do that. Now with electronic fuel and ignition, you don't have to put your foot on the gas. You just turn the key, right? Or you could learn the electronics of how the signals all go, how the mechanics work with the starter, the solenoid, You could turn into a high-level automobile mechanic, or you can stick the key in it. So it's not necessary, in my opinion, that you be able to take the car apart and put it back together. nor that you dig into and find out the reason for every price movement, but it is really important that you understand that there is a reason, and that the reason may or may not be something that's easy to see or explained. But in general, at the bottom, guys, there are no coincidences. There's always an explanation. There's always a reason. Price movement will always tell the truth. Well, usually. Guys, there are certain things that are manipulation tools out there. There's outliers, events that just kind of defy description. And with algorithmic trading and some of the stuff that's going on with high frequency, you can have manipulations that may not make any sense at all, even if you know what happened. But those are not the case normally. Normally, the price movement will tell the truth. What does that mean? That means that the price movement is always what the market believes, i.e. the people trading the market, that the news is actually worth. Okay? It's what it's worth. You can say, my house ought to be worth $690,000. Why? Well, because my friend sold his. It's just like it last year. Well, the market's at 550. No, it's 690. Well, guys, you can run that argument up and down the flagpole all you want. The fact is if the market says it's worth 550, it's worth 550. Okay? I don't understand the price movement. Of course you don't. You're not looking at it pragmatically. Pragmatically, market changed. Real simple. Market changed. All right? All right, so the explanation. Guys, CNBC has a bunch of talking heads. I love the little song, Billy Joel's, you may be wrong, you may be right. Guys, they half the time don't know what the heck they're talking about. They're filling time. They got 24 hours of program they have to fill, and they talk, and they talk, and they talk. It's predictable. CNBC, and this means everybody in the media, they're predictable in the sense that people will feed them information knowing that they will put it out there because they got to fill the time. So that's one reason why there's some manipulation in news and information. I call them useful idiots. They rarely investigate anything anymore. They're mostly just spokespersons reading a script. And when they read a script and just fill time, that's all they're doing. They're just reading a teleprompter. So you got to be careful. Financial reports, that can be a good explanation. It's hard to hide from regulated reporting. The national standards for accounting, if they follow those, you will find information, good information that explains things. However, it's illegal to manipulate data, but it is still done all the time, right to the edge of legality, right to the edge of what can we get away with. Still happens all the time. Some people out and out lie, and when they get caught, it's devastating. You'll see huge movements in stocks when they find out that the CFO, in conjunction with the COO, cooked the data. That's a big deal. Another reason that you can get explanations is whistleblowers. People will come out, they'll do inside baseball, which simply means that they'll give an insight as to what's really going on in this company. That's always interesting, and it happens every once in a while. So let's talk about patterns and signals. When we have price movement, we look to see if there's patterns, and we look for signals. Signals meaning indicators. Guys, I'm going to make kind of a bold statement. I'm not trying to offend anybody, including myself. And when I say that, I am a chart guy. Okay, I'm a candlestick guy. I like patterns. I'm a pattern guy. But patterns are just shapes. That's it. Okay, patterns are just shapes. I got a wedge. I got a rectangle. I got a circle. I got a square. Whatever. It's a shape. And indicators are just data. It's garbage in, garbage out. You plug this in, the data spits out this. So are they magic? No, they can seem like it. Like, whoa, look at that. That it went right from the bottom of this wedge right to the top of the wedge, just like they said in the book. And it can seem like magic, but it can also drive you nuts because a lot of times it doesn't work. And the point is that sometimes it doesn't work. Okay. It's just data, and you've got to be able to sort this out, folks. You got to be able to put it in context, or it'll drive you crazy. Okay. So when do they become significant? I.e. news, i.e. patterns, i.e. signals, i.e. shapes, patterns, indicators. Well, and this is a little tongue-in-cheek, but it's absolutely 100% true. When do candle patterns become significant? When they're right repeatedly on that particular stock. When do shapes, patterns become repeated or significant? When they're right repeatedly on that particular stock. When do indicators my MACD, my RSI, my Chankin theory, whatever you want to name. When is it significant? Well, when it's right repeatedly on that particular stock you're looking at. When is news significant? Be careful about that. Don't put too much weight on that ice. Okay? Now, guys, I say that, and that's not to be cute. It's what I truly believe. Price movement and targeting. When price moves to a particular target, i.e., we predicted it. We said there is a support level here. There's a resistance level there. However you come up with that price movement was usually triggered by some kind of news. Well, I didn't hear any news. Doesn't mean there wasn't any. Guys, a lot of times stocks will take off and move because of inside information. Okay, somebody knows there is some news. It just isn't out to the general public yet. But it got out to enough people to where it started a little bit of panic, and you got some big players that are moving stuff. And it's because they think or they hear some kind of news prior to the public getting it, and it starts to go. And then eventually the story comes out, and then we get the explanation for why. Okay. Now, many variations in the news. The news can be about a particular stock. It can be about a particular sector, or it could be global. It could be geopolitical, weather-related, natural catastrophe, or a natural disaster. There's all kinds of things that can trigger it, but there will be some news behind price movement. Price movement doesn't happen without somebody thinking that the status quo is not right. Where it's trading at right now is not right. It should be higher. It should be lower. Somebody's got to think that, and they've got to have a reason for doing that. Now, again, I'm not discounting the fact that there are manipulators. There are people who naked short sell stocks. It is illegal. When they get caught, they get thrown in jail. Does it happen? Yes, but usually it's on smaller stocks that can be manipulated. It's not on the kind of stocks that you're used to probably seeing and dealing with. All right, let's talk about direction. Now, where there may be some ambiguity in targeting, the direction is usually predictable. Now, let me go back and just step back a little bit. From a target standpoint, target is support and resistance. It is places where we look at and think that the stock will likely go from this point to that point. Why? Why did you come up with that target? It could be a point on a chart that is defined by the shape. It could be a Fibonacci, a number that is calculated that says this is the number. Usually there's correlation, by the way, and Rob and I are in very good sync on this. Usually there's correlation between the chart and Fibonacci's. Okay? In other words, it makes sense. And it's a double confirmation. Guys, if you can get targeting confirmed by the chart, by a Fibonacci, by an indicator, by even news, if you get 2 or 3 or 4 pieces of data that all point to the same number, it makes it a stronger number. Okay? You got to be careful when you have one thing that points to it. Oh, I really like this signal. And the other 3 are pointing the other direction. You got to be careful about that, like real careful about that. Okay. But direction is simpler. If good news happens, it usually goes up. Bad news happens, usually goes down. Not always. Sometimes you have to look for the rest of the story, but generally those are true. Now, what does that mean? Well, that just is a direction. Does it tell you how high? No. Does it tell you how far low it's going to go? No, it doesn't. But news will generally give you a direction. Then you've got to look for your other tools, your indicators, your candlesticks, your chart, your Fibonacci's. You got to have something to try to come up with a target. Okay. But those are the components in price movement. So where it goes can be more predictable. What does that mean? Well, there's a reason why targets have popularity and why people spend a lot of time trying to figure out how to target where the next move is going to go. There's a principle here I want to teach to you. Again, these are general principles. To get into detail, guys, there's a lot that I can teach and I want to teach you about shapes, which is patterns, indicators, candlesticks, which have to do with reversal points, changes of direction and also continuation, but primarily changes of directions. But the principle is this: prices tend to move, when they move, to a safe harbor. What does that mean? Guys, a safe harbor is equilibrium. Okay? A safe harbor is an equilibrium. What does that mean? That means when the buying and the selling pressure are equal. Buying and selling pressure balance out, and a stock stops moving either up or down, and it goes into a tight trading range. When it stays in a tight trading range, it's interesting. When you talk to people, they will reveal which one of the camps they're in, because basically there's two camps. People who get frustrated with a stock that is range bound, that it's stuck, it's not moving anyplace, is because they're basically adrenaline junkies. But there is a lot of part of the trading world that loves the cruise control, the cruise crowd. They love to just sit back and let a stock deal in a trading range. They're happy with it. Why? Well, because there is a lot of people that are trying to change portfolio positions. They're trying to load up positions in a portfolio. They're trying to balance out a portfolio. They're trying to move large numbers of stock. When the stock is moving moving fast to the upside or to the downside, it makes it really hard to do that. So there's a big part of the market that likes it when it settles down. There's another big part of the market that loves it when it's moving from high to low, from low to high, from this point to that point, from this safe harbor to that safe harbor. It's two different personalities. You usually don't have a mix. Now, there are no such things in my mind as permanent bulls and bears in the market. There may be some little exemptions to that, but not really. Most traders, well, let me qualify it. Active traders are willing to be bearish and bullish. They really don't care. They just want to be on the right side of what the stock is doing. But there is a good sized group in the market that likes it when it gets just in a static form, right? In just in a trading range. It's not going wild and crazy. You want an anecdotal story? Back in the 80s and 90s, when Microsoft and Dell and all these companies were getting started, they would manipulate their stocks and drive them higher, split it, drive them higher, split it. Just the price was moving all the time. And by moving all the time, it was making money. But those very same companies, the goal of Microsoft and Dell in particular was to split their stock a number of times, get their capitalization up to a certain point, and then go flat. They wanted to go flat. They wanted to become boring. They wanted to have something that was almost passive, right? They wanted to get there like the big boys. But to get there, they had to get the stock built up and get their capitalization built up. So for a while, they were just driving their stock up and down and up and down, or, driving it up and splitting repeatedly until it got to a certain point, and then they stopped. They wanted to go the other way. So there's definitely those two camps in the market. It's huge that you understand that, because it helps to explain price movement so much. Jim, I didn't ignore you. Well, I did ignore you, but I want to go back and acknowledge your comment. He said that the concept of buy the rumor, sell the news. Do I have the saying correct? Yeah. And that there again is speculating. That's speculating on what you think the market is done. Jim's comment is essentially, by the time the news comes out, it's usually over. That's one of the anecdotes in the market. That's not completely true. In fact, it's completely false in some circumstances, but it is anecdotal, which means it applies some of the time. There's a lot of things that are anecdotal anymore. There's things which used to be true, and so they became an anecdote, and everybody can quote it. But if you look at it critically and say, has that happened in the last 5 years? A lot of times you go, actually, no. Well, why do we do it? Like the Santa Claus rally or some of the things that are just innocuous in the market. Several of those things haven't happened in years. It's just that we got used to hearing it, seeing it on CNBC and people talking about it. So everybody talks about it every year at Christmas or every year at Thanksgiving or whatever it is. It's September. But in the reality, if you look and find out, it hasn't happened for 5 years, 8 years, 10 years. Well, why do they keep talking about it? Because they're talking heads. That's all. All right. So let's talk a little, let's just, I've covered some of this, but let's talk about the cruise control, the cruise crowd, and the adrenaline junkies a little bit. Guys, price behavior is always making somebody in the crowd unhappy. When it's moving, the guys in the cruise control are unhappy. When it's just sitting there, the adrenaline junkies are not happy. The range bound, when it's calm, that's good for those trying to move large quantities and positions. When it's roaring, moving out of the trading range, the speculators are making money. The earn on the turn crowd. Guys, the idea of looking at something as innocuous as candlesticks, okay? Innocuous, ubiquitous, it's everywhere, right? Everybody talks about candlesticks now. Pretty much it's universal application. However, the vast majority, there are almost 3 times more reversal signals in candles than there are continuation patterns. Think about that. Most of the candle patterns are reversal patterns, and most of them are not very good. Why? Why are they mostly reversal pattern? Why are there so few continuation patterns? Because, because the reversal patterns are what it's designed to look for. Continuation patterns, guys, are basically lousy reversal signals. So if you looked at the very best reversal signals and you started moving down from the top, down lower, less frequent, less accurate, you're going to reach a point where they're so inaccurate that when you get that signal, it's probably going to keep going. That's what a continuation signal is. It's a really lousy reversal signal. Okay? And essentially, that's what it boils down to with candlesticks. Most of them aren't very good. And when I teach you candlesticks, I help you cut to the chase, to the bottom line, so that you can understand which candles you should pay attention to and which ones you shouldn't. And the good news is out of over 100 patterns, there's not a whole lot that you have to pay attention to because most of them aren't very good. The trick is knowing which ones to pay attention to. That's the whole point on candlesticks. All right, price movement. As I said, it always makes sense after the fact. When the real news gets out, if the real news gets out, it'll make sense. It tends to go to a safe harbor. It tends to find an equilibrium in trading. Patterns, indicators, etc. They all have a value proposition. What does that mean? It means everything is good in its own context, in its own universe, in its own point in time. Be careful about generic things like someone who says, that's a good signal, or that's a good candle pattern, or this is a good chart pattern. Guys, ask yourself, what the heck does that mean? What does good mean? What does good mean? If they can't tell you that it's 75% accurate on this stock over the last 6 months, then what they just said, quite frankly, is not worth even listening to because it doesn't mean anything. It means nothing. Yeah, Jim, like the summertime slowdown, don't trade. Yeah, not recently. You're exactly right. You know, what happens in September? What happens in October? What happens in November? What happens in December? What happens in February? You know, it's all these anecdotal things. Sometimes they work, sometimes they don't. And sometimes they still work, and sometimes they haven't worked in the last 7 years, but nobody talks about that. They just keep talking about it because it's good stuff to talk about on CNBC. So guys, when somebody talks about a good signal, if they can't quantify that down to something that you can actually use, then treat it for what it is. It's just words. Doesn't mean anything. Okay, so I'm going to stop using slides and I'm going to pull up a chart and we're going to take a look at some things. But I just want to tell you what's coming up. My classes, my training, Candle Power is definitely something that is going to be on the book shortly, and you're going to want to take advantage of that. Again, how to properly use Japanese candlesticks. Are they important? Yes, very important. Are they easy to use? Only if you have a lot of good information and training, but that doesn't mean you know 100 patterns. It means out of the 100 patterns, which ones do you need to know? That's what's hard. Okay, and how do I make it useful? Signal simplification. How do I use indicators? Any kind of a signal. Which one do I use? Do I trust it? Can I lean on it? How many indicators are there out there, guys? Look on your Trade Navigator and just pull up the list of indicators. I mean, there is like 40 of them, at least. And I got to be careful, but every technical bean counting analyst can sit there and crunch numbers and come up with something that may or may not be important. Guys, trust me, I am a huge fan of analytics. I really am. I love, one of my favorite movies is Moneyball. I just saw that the other night. How many of you seen Moneyball? Just give me a quick yes. Brad Pitt, Billy Bean, Moneyball. Has anybody not seen Moneyball? It's really okay to say no. I mean, really, it's okay to say no, I haven't seen it yet. Anybody? Okay, Kevin. And anybody else who hasn't seen it, watch it, please. Why? Because it teaches an incredible principle. Billy Bean and this young computer analyst, this back in the day when punch cards was the way you got printouts from a computer, and it's the way you programmed them. They revolutionized baseball. They revolutionized it by taking data, raw data, and converting it into something that you could tangibly wrap your head around and go, oh my gosh, look at this correlation. Raw data and analytics revolutionized hockey. In the Malcolm Gladwell book of Outliers, up until a few years ago, all the big hockey players, when I say all, over 90% of all the good hockey players were born between January and March. All of them. Why? Because people didn't understand the analytics. There was a natural tendency to segregate young hockey players, because when you're 5 years old, if you're born in January or February and another 5-year-old is born in November, you're 10 months apart. Guys, at 5 years old, 10 months is huge in the development arena. So there was an affinity for picking out these young proteges, these young great hockey players at 5 years old, and they were cut off on a calendar year. And guess what? The ones that were born in January, February, and March were way ahead of the ones born in December and November. And so from an early age, you started treating a certain group of the population as if they were special, and you prejudiced against the others because they weren't special yet. In fact, because of the preferential treatment, most of them could never catch up, because the older ones born in February, March, and January were getting special treatment. As a result, by the time they became 15, 16, 17, and they were going into the pros, they were all January, February, and March birthdays. It was stupid. They were taking 3/4 of the population and automatically taking them out of the pool. It was stupid. But how did they figure that out? A woman who was bored to tears while her husband was watching hockey was looking at the roster, and she said, how come all these players are born in January, February, and March? And her husband said, I don't know. And out of that question came this analytics, and it revolutionized hockey. And now we have a lot more hockey players, better ones, because you're pulling from the entire group, because they don't segregate them like that anymore. It was stupid, but somebody had to come up with the data. Okay. So I like signals. I like that. But when you got 40 of them, my gosh, you got to know which ones might apply to you the best, which ones actually work on the stock you're looking at. You've got to have a little help figuring that out, sorting that out. That's what I want to do when it comes to signal simplification. Charting skills. Guys, I am unabashedly a fan of charting. I have been giving some recognition as being a very good chartist. I accept that. I think I am. But it's only because I've got a passion for it, and I've put a lot of time into it. And I've recognized and shown some things in pattern recognition that kind of stand out in more than one field. So it's something I really enjoy. When you have skills to be able to recognize patterns, it allows you to do a much better job of targeting. And like I say, when Rob and I get down and sit down together, it's fun. In the past, we've done things like, just grab a stock and chart it and tell me where support and resistance are using Fibonacci's. I will use charting skills, pattern skills. And then we compare and goes, boom, same targets. Well, that's good. Now you've got two different disciplines agreeing on the same thing. By the way, if I want to blow your mind a little bit, I can teach you how to look at an options table. To go to your options table in Thinkorswim or wherever it is, and be able to show you where support and resistance are for this month's options, just based on based on the options, being able to look at the chart and say there's support at this price, there's resistance at this price. Then you go to the chart and you look at it and go, boom, look at that. Okay. So multiple disciplines or multiple confirmations will give you a lot better idea of where to place targets. More confirmations, charting fibs, Jim says, absolutely. Trip says the Cowboys changed the NFL draft with a computer. Exactly. Great point. Robert says, it's been a while since I've seen it. I need to watch it again. You should, because I mean, it came so close to not working. There were so many reasons. He had so much crap thrown against him. There were so many reasons not to stick with it. But because they did, it changed everything. It changed the game. It's really a remarkable movie when it gets right down to it, guys. All right, so let's take a look at. I'm going to hang on here. I'm going to pull my. Yeah, let's see. I'm going to stop sharing for just a minute. We'll go back to the main screen. And I want to pull up a chart, and we'll do a little bit of, we've got about another 10 minutes or so, 10 or 15 minutes. I want to just apply some of this. Okay. Let's take a look at the application side of this. See if we can use some multiple indicators on, just to give you an idea. Okay. And let's see. Hi, Amelia. I see you're in the class. Lovely to see you, my dear. All righty. So here we go. I'm going to share my screen. And I will let you guys, we'll do a little bit of the Johnny, if you remember back to the Johnny Carson days, Stump the Dummy. Somebody pick a stock. Somebody pick a stock. We'll do this just cold. XLE. All right, here we go. This is great because I don't deal with this one. This is a energy spider. Got to move the text chat so I can see. All right. Move this over a little bit. All right, we're going to do some cold analysis on this. First thing I'm going to do is I'm going to look back far enough. I'm going to go back even a little bit farther. I want to see some perspective. Okay. So what do we know about this stock? Trading at about $66 right now. Last July, it was down at 54. Okay. So in a year, it's been almost a year, guys, 10 months. It's gone from 54 to 66. It took a year. You go back to December of 16. It took 8 months prior to that. Yeah, 8 months to go from 66 down to 54. And now it's taken, let's see, December, July 17. Yeah, it's taken another about 10 months to go back up. So in the first place, it looks like it's a nice volatile pattern, but it takes a long, long time to move a few points. Okay. Right. Yeah, I get that, Jim. It is. It's a spider. It's in that sector. It's an index, but it's a spider. It's in the spiders. What we have is a range. If we look at this, Okay. This range right in here around 60, 66-ish has had a lot of activity when we look back over the last few years. And go clear back to October of 14. We had 1, 2, 3 failed rallies. It jumped out a little bit, hit 68 and back down here to 66. Then back in December and now recently. So what is happening right now? Of the last 6 years, 7 years, okay, 6 to 7 years, this index has had a real hard time getting above 66, 68, real hard time. Okay, it's been as high as 82. If it were to get past this 66, 67-ish, maybe even up here to 68, there we go. If it were to get past there, we would look at this and say, well, you got another resistance point here. And so from a pattern standpoint, we are reaching a point that has a history of being a major resistance point. What would be significant about moving up and reversing here? Well, you would be following the pattern. Okay. If you got up here and you moved past 70, or excuse me, if you failed to get past 70 and you reversed back down, you would simply be following the pattern. That's all. You'd be following the pattern. Now, what if you faltered here and you hesitated around 67, 68? What's going on here, guys? I'm pushing my finger around with the mouse and so let's get some more space here. Oh, did I? Hang on a second. Did I not have that pushed out all the way to today's date? I thought I did. All right. Hang on a second here. Okay, so where I was drawing my lines was back in January, apparently. And I didn't realize it looked like I had it extended all the way out. Maybe I didn't. So what we had happen last time we were up here at the 68.70, it did exactly what it looked like it was going to do. We hit resistance. We tickled 70 and it's come back down. The 54 mark was the bounce point, and it came down and bounced off at once, 2, 3 times. When it broke through 54, then we went back, and I'll go to a weekly chart. Wow, I can't believe that was back there. I did not see that. It looked like we were at the end. I don't know why it did that. Anyway, multiple resistance. Now we look for support. So let me draw a couple things for you here. From a pattern standpoint, going back to 16, we had 1, 2, 3 rising rally points. We had repeated resistance points. This is called a wedge pattern. So we came up against a wedge. If we broke to the upside, our target would have been absolutely up there to that 82 mark. Okay. This would have been the ultimate target of a breakout above that repeated resistance. Didn't happen. When it broke down, it finally broke the pattern. Now, guys, one of the rules in patternings is about 3 to 5 times in patterns break. They also tend to reduce their significance. So we have 1, we have 2, we have 3 pattern repeats on this, and then it breaks down. Each one gets a little bit smaller, and then it breaks down. Okay. All right. Now, when we break down, we come down, we test the 54, we come back up, fail to go back up inside, and then we start falling back down. Test 54 again, test it a third time, it breaks down. This in and of itself is another wedge pattern. So now we have lower bottoms. We have 54 being tested on the bottom again. And when that pattern breaks down, then we look to the left. We always look to the left. Okay. The next resistance point that we look for would have been this big rally report or rally spot right here, but it's a strong knife point turn. It's repeated back here. If I can get that to move a little bit. Just a minute. Okay, when that pattern breaks down, then we look to the left again and we say, oh my gosh, where are we going? So we come down to these guys right here and we say, help. Are you going to make it work? And we see that we come down and test that twice. We have a double bottom right side up. Double bottom right side up is a pattern recognition on a reversal where the right side is higher than the left. That's a stronger reversal pattern than a regular double bottom. And then we start climbing back up. In the big picture, everything falls back into the big picture, guys. This is what we're looking at right here. Okay. You take this and my mouse is being a little bit tough on me here. All right. You take this pattern right here. You take all of this concentration of equilibrium right in here, and you're going to have back into this zone between 54-ish and 60. You're going to have a big collision spot. This is where the cruise control crowd is going to hope that this thing settles down. They're going to hope it settles down and they can get it to get stuck in this range again. So as we approach 54, again, we're getting right into the sweet spot. All of this price movement, all of this compression, and then with descending tops coming down, putting a lid on it at about 60, this would be the largest target. Now, can we throw Fibonacci's on top of this? Sure. Can we throw technical indicators on top of it? Sure. Can we look at candlestick patterns? Yes, we can. Can we look at news? We can do all of that. But all of those things are factored into the picture. Guys, when the price movement actually finishes drawing a picture, all the news, all the indicators, all of the other stuff is already factored in. It's already been digested and valued by the market, period, plain and simple. So that's what we got. This is a combination of putting skills together. And as I said before, the classes that I'm going to be presenting here is going to be revolved around candlesticks, around charting, and the context of price movement so that you can properly target with good expectation and use multiple confirmations to make that work. And then ultimately we'll get into strategies. Okay. So, yeah, Tony, whoever is saying that from Hey Tony, bring it up, talk to him. I don't have any say in that, but that's an interesting idea. All right, guys, take care. God bless. Have yourself a wonderful day. And like I say, just go real careful about news. Take it with a grain of salt. Everything else shakes out in the picture. I'm a big believer in the pictures, but indicators and all those other tools, their context and their strength is going to be based on how good it is on the particular stock that you're using in the most recent history. Bottom line. All right. Take care, guys. God bless. Have yourself a great day.